welcome to our last breakfast of the year, organized by the company Secretarial and Governance Officer Committee Avila. I'm really glad today that we have Audrey DEREP with us from NautaDutilh, Tax Counsel in the Advisory Department. As you know, the aim of the committee is to promote the company's secretary and governance professionals, to help them, give them trainings, and also a few years ago, already 6 years ago, a specific certificate was prepared and can be achieved for a secretarial and governance officer. So in the scope of continuous training for corporate secretary and governance professional, today we have the ability to speak about a very interesting and always important topic about the tax liabilities and tax obligations of the directors in a company. So the presentation will be given by Audrey and will be split in two parts. There will be a part to a first a comprehensive understanding of the tax liabilities of the directors, and then we'll go more deeper in specific practical guidance on the main tax obligations of the directors. And here it will be split on two subparts. One will be a reminder on the tax deadlines, which is very useful for everyone, and especially COSEC to keep in mind. And also the second point will be on the recent developments impacting the tax obligations. So now, Audrey, if you want to present yourself to the team, and also after I'll let you start the training. Oh, sorry, I forgot about that. The presentation will be shared with you at the end of the training, and we will keep the question for the end of the training. If there are in the meantime some questions, we can address them in the chat, and I'll just share them at the end if it works for everyone. Audrey, the floor is yours.
Hi, everyone. Welcome to this presentation on tax liabilities and tax obligation. I'm Audrey. I work at NautaDutilh. It's a business law firm in Luxembourg, for those who don't know it. I'm a tax advisor. We advise on a wide range of clients, sectors. So we have institutional clients, corporate clients. We also advise on a very wide range of sector, like real estate, capital markets, real estate, private equity, and such transaction. We also have tax compliance services, and we also assist with FATCA, CRS, and CBC. So that's about me. And now we can start with our presentation. In this first part, I wanted to make a comprehensive understanding of directors' tax liabilities, because we talk a lot about it. I think it's interesting to go into details and to understand first what type of liability does a director have. I'm talking here about directors, but I'll use the word directors, but it's for any legal representative of a company, just using the word directors to make it more easier. So the directors have a joint liability with the company. So that means that the tax authorities can go either after the company or either after the legal representative, the directors. It's also a personal liability. The Luxembourg tax authorities, they can choose if there is an issue and they engage the tax liability of the directors, they can choose after which directors they want to go after. So usually what we see is that it's easier to go after a Luxembourg resident director or even a resident in a cross-border country like Belgium or France or Germany. It's much more easier for them than to go after directors that are based in the UK or in the US. But in practice, they can go after any director. When we say the directors, the directors also have a tax liability if they are directors of a company that is the legal representative of another company, like the manager of a SAL that is itself the general partner of a CSP or another type of investment fund. So who bears the tax liability? It's, as I said, the legal representative, so managers, directors, but also the liquidator of the company. And this also includes the shadow directors, so the directors that are not officially directors of the company, but that have in practice an effective influence or control over the business of the company. This tax liability is for all the directors, not only those that are in charge for the day-to-day management, except for VAT, which is a specific case, but for other taxes, all the legal representatives bear this tax liability. So for what? For all the tax obligation of the company, including the filing of the tax returns. It's for the payment of taxes, but also of tax fine and interest for late payment fees. And for any taxes, so it can be corporate income tax, municipal business tax, net wealth tax, withholding tax, on dividends, but also on wages and salaries. This goes even further based on case law, because the directors can also be held responsible for tax refunds or tax credits that have been wrongly granted to the company due to a wrongful misconduct. So it's not only about the tax that haven't been paid, it's also about the tax that have been refunded to the company or the credits that have been granted to the company. So now you know that as a director, you have a personal tax liability about which taxes, but in which cases. There are three elements that need to be fulfilled for the tax liability of a director to be engaged. So the first is a failure to pay taxes, fines, and interest for late payments. The second is a breach of the tax obligation of the entity. And the last element, which I think is the most important to discuss, is that this failure should result directly from a wrongful misconduct. So a wrongful misconduct means that if the legal representative can prove that he or she was diligent in the management of the business of the company, then there will be no tax liability engaged. So here we would make a comparison between the act of the director and with what a similar director in similar circumstances with the same degree of knowledge would probably have committed. So the misconduct can be active or passive. So not filing a tax return is also a wrongful misconduct, even if there is no active action. When the Luxembourg tax authorities want to engage the director of the liability of a director, they also have to sustain their appreciation of the wrongful conduct. So they cannot only say there was a wrongful misconduct, they have to say what it was and why they think it's wrongful. There can be a wrongful misconduct even in case of delegation to a third party or distribution of tasks between the directors. So that means if there is a board of managers and some tasks have been delegated to a specific manager, the other managers cannot escape the liability by saying we delegated to this manager. So the responsibility is borne by everyone. The gross misconduct is not the same as a tax fraud. So the director will engage his liability if there's a tax fraud, but not only. Gross misconduct is larger than just a tax fraud. And for the delegation to a third party, what I wanted to add is that I told you that that a director cannot escape his misconduct because of a delegation to a third party. But in certain case law, the delegation to a third party was seen as an element among a bundle of clues that will not totally exonerate the director, but that could be one of the arguments to lighten up the wrongful elements. Like in that specific case, the court said, the court judged that the director did well because he surrounded himself with specialists, with well-known specialists, and he trusted their advice. So it has, in this case, the court has considered that it was enough to lighten the wrongful misconduct of the director, but not to exonerate him totally. For VAT, VAT, it's too early stage. We don't have enough case law to confirm that the wrongful misconduct will be appreciated in the same way, but we would expect that it will follow the same path. So I've set up a few examples of wrongful misconduct because it's still a bit theoretical, my explanation. So I wanted to show you practical example of what can be a wrongful misconduct. So not withholding taxes on a hidden dividend distribution. So, you know, company makes regular distributions, but then in some cases there can be a requalification of certain operation into a hidden dividend distribution. And if the company is not withholding the taxes on such hidden dividend distribution, that can be a wrongful misconduct. Not paying withholding taxes on wages to Luxembourg tax authority is also a wrongful misconduct. In case law, there is no other element that is taken into account. If the payment is not made, it's a wrongful misconduct. There are no exonerating elements that can be appreciated here to reduce the liability. Making false invoices is also a wrongful misconduct. Not preparing and filing accounts and not filing the tax return or late filing of the tax return, these have all been considered as wrongful misconducts of the directors. The lack of surveillance of tax obligation delegated to another manager, a third party, or an employee is also a wrongful misconduct. So it's not enough to say, well, we hired this company to prepare the tax return. You also have to have an active comportment and send emails reminders to check where they stand, review the tax return, ask yourself questions, ask questions to the person that prepared the tax returns to make sure that your conduct is not qualified as a wrongful misconduct. Then the setup of a tax evasion structure. This is a very gray area because everyone can choose the less taxed way, but then it can also not be tax evasion. So I appreciate line 16 here. So if there is a setup of tax evasion structure, that's a wrongful misconduct. Another example of misconduct is the repayment of capitals or reserve to the shareholders that will materially decrease the liquidities available for the tax payment. So you cannot repay the shareholders and not keep any cash to pay the tax authorities. And in the last case, the last example, it's the case of tax provision. This was a case where a company, the managers of the company were fully aware that the tax unity that they requested could be denied because there was a late filing of this request, but like they missed the deadline a few months. And they didn't make any tax provision to make sure that they could pay taxes if the tax unity was denied. So in that case, it was considered also as a wrongful misconduct. So what's the temporal scope? This wrongful misconduct, this tax liability, is for all obligations that are borne during the time of the mandate, but then also for tax obligations that are borne before the start of the mandate if the director has taken no remedy action. So when you start a mandate, carefully check the tax obligation of the companies for the past, and if you see that there are some irregularities, take actions and document the actions that you take to make sure that you can prove that you had a conduct that you didn't had a wrongful misconduct. This is for the tax obligation that born before the start of the mandate. This is still case law at the level of the tribunal, so it can be the object of an appeal before the court. The court can take another position. We don't know yet, so it's best to be prudent on this. The procedure is quite simple. The Luxembourg tax authorities will issue a guarantee call notice, so un bulletin d'appel en garantie, that is sent by post mail to the domicile of the director. There is no need for a specific type of send. It's just sent by post. For VAT, it needs to be a registered mail, but not for the other taxes. There are also appeals against this guarantee call notice. I won't mention it because it's very specific, but you just need to know that they exist just in case you encounter this situation, which I hope you won't. So what would be, so our advice would be, make a tax due diligence before you have a mandate. Just check if the tax return has been filed, the tax payments have been made, and take remedy actions. And what's very important is keep proof of your due diligence during your mandate. So write emails. If there was like an oral conversation, make sure then you write an email after that summarizing what you discussed over the phone. If you call the administration, make sure that you send an email to the other managers, for example, explaining the conversation you had with the Luxembourg tax authorities or with your tax advisor. Just keep proof all along. So you would be able at the end to justify that you didn't have a wrongful misconduct. For VAT, it's a little bit more specific. It's substantially the same as I explained for corporate income tax and natural tax and so on. But for VAT, the tax liability will only lie on the director that is in charge of the day-to-day management. So that's specifically foreseen by the law. If there is no director in charge of the day-to-day management, it will probably that it is likely that the tax liability for VAT would then rely on all the directors. And to add a few words, there are also cases where the directors could, where the tax liability of the directors could be, directors wouldn't have a tax responsibility. That is mainly the case if there's a prescription status of limitation, which is usually 5 or 10 years after the fact. The tax liability of directors is not discharged if there is a release by the company. So if the company releases the directors from their responsibility, that doesn't discharge the directors of their tax liability. It's same for the tax return. A director cannot discharge from its tax liability just saying that he didn't sign the tax return or didn't review the tax return, because that would be a lack of surveillance. When a director resigns, is discharged of his responsibility, but it's only after the publication on the Luxembourg Business Register. So if you resign your mandate, please urge the company to publish your resignation, because for the time between your resignation and the publication, you can still bear a tax liability. So this was all about what are the tax liability of a director. And in this second part, I wanted to highlight like a practical guidance on the main tax obligation. So as Richard said, there will be 2 parts. The first part will talk about the deadlines for the tax filings and the tax payments. And in the second part, we will see a few updates on recent changes and also upcoming changes that can affect the tax obligation of a director. So, useful reminder on tax deadlines. I know the tax authorities here in Luxembourg, they are quite flexible with the deadlines, and they tend to not issue fines and penalties when there is a delay in the filing of the tax returns, but they still can do it. So it's important to remember the deadline. The deadline has changed this year. So since 2023, the deadline for filing the tax return is at year end. For accounting year that are following civil year, but also for diverging accounting years, and also for the liquidation and the dissolution. Because before it was May, and then they were like flexible until 31 of December. So it's kind of practice that is now official. So it's 31 December. They are not allowed anymore to grant authorization to extend the tax return deadline. So there was a practice. Some companies, when they were aware that they could not meet the deadline, they were asking an extension to the tax authorities. And this is not allowed anymore. There are sanctions in case the tax returns are not filed. It can be a tax supplement, a penalty payment, or a late interest payment. For withholding tax return, just keep that in mind because the timing is very straight. It's 8 calendar days from the moment the income is made at disposal. So if there is a dividend distribution and there is nothing specific foreseen in documentation during the board meeting, that the dividend will be deemed made at disposal on the day after the board meeting. So then you have 8 calendar days to fill the withholding tax return. For VAT returns, it's the deadline is 15 days after the end of the period. So the period can be monthly, quarterly, or annually. After the end of the period, 15 days for filing, and for the annual VAT return, it's on the 1st of May. If the VAT activities end during the year, the VAT return must be filed 2 months after the end of the activity that was subject to VAT. So for the tax payment deadlines, there are I don't know why they did this. I think it's very confusing, but there are different deadlines for corporate income tax, for municipal business tax, for net wealth tax. It's on the 10th of the month, the 15th, and it's in February, June, September. So I would personally do everything on the same date, but well, I cannot influence their choice. So you have various deadline. I think in practice, what we see is that our clients, they pay everything on the deadlines for MBT and net wealth tax because it's easier than to make payments every month. For VAT, it's 15 days after the end of the period. So we are talking here, sorry, I didn't mention it, but it's for advance payments. For VAT, it's 15 days after the end of the period, so monthly, quarterly, or annually, depending on the period that for the company. And then the balance payment is to be paid 1 month after the tax assessment. So you file the tax returns, the tax authorities issue tax assessments. And when the tax assessments are issued, you have the company has 1 month to pay the taxes. And that's even if the company does disagree with the tax assessment that are issued by tax authorities, and even if the company will make an appeal against the tax assessment, the taxes have to be paid. There are sanctions. If the taxes are not paid on time, company can be subject to interest for late payments. And in certain cases, there's a possibility to request a payment in several installments, but that has to be duly motivated by financial distress. And the tax authorities, they tend to be very reluctant to grant these several installments. So you have to make sure that you document your request duly and that there is a financial distress. So that's about the tax payments, deadlines for tax payments, tax filings, which is very important in the case of your tax liability. If for any reasons, because as a manager, as a director, you don't always have the full control over the payments and the filing and the review of the tax return, if you see that some deadline will not be met, just document it, that you did the follow-up, document the reasons, everything by email, by writing. So you'd be able to prove that you didn't have a wrongful misconduct with regard to the tax payments and the tax filings. So after the tax liability of the directors and the deadlines for the main tax obligation, which are the filing of the tax returns and the payment of taxes, I wanted to go through an overview of recent and upcoming developments that can impact the tax obligation. You know, tax is a very moving area, especially these times with all the OECD and BEPS projects. So it moves fast, and it's important to keep updated of the tax obligation, especially as we are in an area where we are requesting more and more documentation, more and more there is more and more exchange of information and documentation and proof of all the transactions that are entered by the companies. So one of the updates of this year is the circular and the facts on the reverse hybrids. Maybe you've heard of reverse hybrids. Reverse hybrids are our entities, so Luxembourg partnerships, as you'll see here, the SCSP in orange in the chart, they are treated as tax transparent for Luxembourg tax purposes, but for the non-resident investor, they are treated as tax opaque. So it's hybrid. It's transparent for Luxembourg, but it's opaque for another jurisdiction. This rule, they only apply if these non-resident investors are associated enterprise, so 50%. And if these non-resident investors who consider this Luxembourg entity as opaque, if they do not tax the entity's net income. Because in Luxembourg, we'll say this entity is tax transparent, so that means that the income will be taxed at the level of the investors. But then the investors say that this company is opaque and that the income in their own country, they would say the income is subject to tax in Luxembourg. So we end up with income that is subject to tax, that is not subject to tax in practice. And there's an exclusion for collective investment vehicles, which are not subject to this rule. This rule applies as from fiscal year 2022. And how it impacts tax obligation is because it has changed the tax filing obligation. So we first had this circular that has been issued by the Luxembourg tax authorities, where they clarify some points about this rule. It's quite technical, but they clarify the tax statute of a reverse hybrid, which articles of the Luxembourg income tax law are applicable, how to determine the tax base. I won't go into that details because it's very technical. What is important is that they have also issued FAQs, so questions on this is really practical guidance on tax declaration for tax transparent entities. So for those who are manager directors of tax transparent entities, before there was the Form 200, the Form 300, and the difference was quite easy because it was either there's a commercial activity carried out in Luxembourg, it's a Form 300. If not, it's a Form 200. So that was quite easy, and now they have complicated our life with a new form, which is a Form 205. And Form 300 is still easy. Is there a commercial activity carried out in Luxembourg? There's a Form 300. Then if there's not, then things become a little bit more complicated because this entity will have to self-assess themselves and to check does the income mainly arise from movable capital and miscellaneous income? If that's the case, they have to fill a Form 205. If they have commercial activity that's not carried out in Luxembourg, they have mainly income from rental of goods, capital gains, movable properties, ancillary income, then they fulfill a Form 200. So it's really each entity will have to check its income to determine which form will need to be filed with the tax authorities. For this year, the tax authorities have sent letters to some entities requesting a Form 2005 to be fulfilled. So some of these entities do not fulfill the condition of this Form 205, but they are still requested to do it because they received a letter from the tax authorities. We are not well sure how well organized they are, the Luxembourg tax authorities. In our clients, we have cases where the clients were clearly not informed 2005. They didn't receive a letter, and when we filed the tax return based on Form 200, the tax authorities then send a request for these companies to also file a Form 2005. And justification was that these companies may in the future, because of their assets, have earn income that falls within the income that should be for which a company should file a Form 205. It was very surprising. We had a case with 3 inspectors. They honestly weren't even sure that they had to do it like this or not. So it seemed that there is still some misunderstanding at the Luxembourg tax authorities. So just make sure that you prepare the right form, and if you receive, and also check if you receive the letter from the tax authorities. So to make it a little bit simpler, mainly the cases where this kind of entity will need to file a Form 205. It's when it receives dividends, interest income, when they have gains from the disposal of major shareholdings, when they have income from carried shares, or from the restructuring of subsidiaries, like income arising from merger, dissolution, demergers of their subsidiaries. So those are mainly the cases where they will need to have a Form 205. So that's important. So make sure that for the tax return that are filed this year, the entities are using the correct form. Another important update of this year is about Alphabet shares. I don't know how familiar you are with Alphabet shares, so I'm just making a quick explanation what are Alphabet shares. So a Luxembourg company which distributes dividends to companies located in certain countries, mainly countries that do not impose taxes. There's a withholding tax on this dividend. A company can then decide, obviously for economic reasons, not only for tax reasons. The company can then decide to divide its share capital into several classes of shares, so 10 classes of shares. Each class of shares have a different economic rights, give different economic rights withholder. And upon a fiction of the law, the repurchase and cancellation of whole class of share is considered as a partial liquidation and not subject to withholding tax. That's so it's for cases like here in our example, the Luxembourg company could repatriate funds to this shareholder in the Cayman Islands without withholding tax. This was all based on practice of the Luxembourg tax authorities and all the condition on how the terms and conditions, how the Alphabet share should be structured. It's all based on practice. There was in 2023, there was a welcome case law that confirmed that this operation is a partial liquidation and it's not subject to withholding tax. That's very welcoming because it gives a lot of security to this practice. Then during this case law, they also confirmed that if the repurchase price of these shares is above the arm's length price, there could be seen as a hidden dividend distribution, and then back to square one because this dividend distribution is subject to withholding tax. So this really shed the lights on the need to justify the arm's length nature of the repurchase price. It's still a case law. The Luxembourg tax authorities have until now not asked any taxpayer, to the best of our knowledge, to justify the arm's length nature. But it's something to keep in mind that maybe in the future they could request a justification. So then we'll probably need to to have an evaluation of the share performed to make sure that the repurchase price is at arm's length. This case law also seemed to suggest that the repurchase and cancellation of Alphabet shares can be considered as an abuse of law. And this is very important because the Luxembourg tax authorities, it's really a confirmation that the Luxembourg tax authorities can challenge this operation as an abuse of law. In practice, this will not happen if all the conditions that are set by the administrative practice are respected. So this is mainly that there are 10 classes of shares, but all the classes of shares have different economic rights. But then also that these classes of shares are implemented at the incorporation of the company. That would be the best case scenario, or at the latest when the funds flow through the company, but not later. And also pay attention to cases where the Alphabet shares have been implemented and there is a change in this in the terms and conditions of the Alphabet shares right before a distribution, because that's a case where the Luxembourg tax authorities could easily challenge as an abuse of law. They would say, well, these changes to the term and condition, they were made only because, only with the purpose of obtaining this tax treatment where there is no withholding tax. Then in March 2023, there was a new bill of law that was introduced that is bringing some changes to the transfer pricing practice mainly. it introduces a procedure of advanced transfer pricing agreements, so basically rulings, but for transfer pricing. So I'll step back here. I imagine that maybe you all know what transfer pricing is, but I'll explain just to make sure. So all the transactions that are occurring between related companies must be at arm's length. So that means that related company must act in the same condition that would have occurred between non-related companies. So just as an example, a shareholder that is granting a loan to a subsidiary would apply an interest rate. And the shareholders and the subsidiary could decide that this interest rate, it would be interesting to have a high interest rate because then a portion of the profits are repatriated to the shareholder and taxed there, and there is maybe less taxes in this country. But here, the Luxembourg tax authorities can requalify this interest rate and say that this is not at arm's length. If the shareholder and the subsidiary were unrelated companies, they would never agree on such rate. And they would requalify, and so less deduction in this case for the subsidiary and less income for the shareholder. So it's very important. It applies arm's length principle. They applies to interest rate on loans. I think it's the most obvious example, but then also on payment of fees between companies and actually on any transaction. That doesn't have to be a direct link. It can also be a few transactions between a few related companies that result where the result is then not in line with what independent companies would have made. So it's very important to also to justify the arm's length nature, to be able to justify the arm's length nature of transaction. So there is no procedure to have some kind of ruling to obtain certainty in advance that the Luxembourg tax authorities also consider this arm's length principle. And there's a draft Grand Ducal decree that has been introduced on local and master TP file. That does not apply to all the companies, only to Luxembourg entities that belong to an M&A group, which has a total consolidated turnover of more than €750 million. So probably it will not concern most of the companies in Luxembourg, but the companies that are concerned here, they have to prepare a local TP file and master TP file. So local file is focused on intra-group transaction. So the local TP file is basically what the companies are already doing now. So they justify their transactions, so the loans that they have received, the loans they have granted, the financing, the financing, their debt financing when they are making equity or debt investments. So we don't think that this local file will bring a lot of additional obligation on the companies. But for certain companies, they also have to provide a master file. A master file is an application of the transfer pricing policies at the group level on the activities, the global transfer pricing policy of the group, and distribution of profits. So this local and master file, they must be provided to the Luxembourg tax authorities upon request. There is no deadline, so it needs to be prepared on the files of the company. It's applicable as from 2024. So that means that each company should assess its situation and determine whether or not it falls within these rules and prepare the local and master file. There are no specific penalties. So that means there is no fine or something. It's the usual penalties that apply in case the company does not transfer the obligation that are requested from tax authorities. But what we want to highlight here is very important. If the company does not provide this justification on transfer pricing, not only those with the TP file, the master file, but any companies, that means that the tax authorities are allowed to proceed with any adjustment they deem appropriate based on information at their disposal. And that could work at the taxpayer disadvantage. So it's very important to justify and to document this transfer pricing policy, the compliance with the arm's length principle for any companies, and specifically for companies that falls within this the scope of this chronological decree. In this case, they have to really prepare a local file and a master file. So it's for the master file, it's really an additional layer of content of obligation. The local file is rather formal documentation requirements. This bill law has also introduced some changes to the procedures. I won't bother you with all the details. I think the two most important points are the publication of annual financial statements. If the financial statements are not published at the Luxembourg Business Register, they are not binding upon the tax authorities. So that means that the tax authorities, again, can say that, well, they can say that basically the financial statements are not binding for them, and they could assess the tax base of the company based on other elements at their disposal. So it's even more important to publish the financial statements. On procedure, specific procedure points, the tax authorities can issue discretionary tax assessments. So if the company has not, or the company or the partnership has not filed its tax returns, and the company can, the tax authorities can issue tax assessments, which are called discretionary because they just base themselves on any elements at their disposal. So they can base on the accounts of prior year or any other element they deem appropriate, and they come in the tax base. Surprisingly, it's always a tax base that is higher than expected. So if the company then wants to take legal action against this discretionary tax assessment, until now the rule was that there should be a significant difference between the tax base that is estimated by the company and the tax base that has been estimated by tax authorities. Of course, it's difficult to assess what's a significant difference. So we have had cases where the difference was, in our view, not really material, but it's still accepted. And other cases where there was, in our view, a significant difference, but they just refused. So now it's clear there must be a 10% gap between the tax base estimated by the taxpayer and the tax authorities. If there is less than 10%, the discretionary tax assessment cannot be appealed on that basis. So again, another argument for filing the tax returns on time. There's also more formalism. I think this was not the most way of recourse that was used, but in the past it was possible to address a recourse to it's a claim to the director of the Luxembourg tax authorities in oral form. No, it must be in a written form. So if when the Luxembourg tax authorities are issuing a tax assessment, a recourse can be taken against this tax assessment with the courts and tribunals, but there are also like a less formal recourse, which is a claim that is addressed to the director of the tax authorities. So it must be in a written form, where the taxpayer then explains in written which is arguments against tax assessment, and the director of the tax authorities can then change the assessment if he believes that the taxpayer is right. So this below, it's really the point to remember is transfer pricing, document justify. It's even more important because there is not only in Luxembourg, but at EU level, but then on an international level, there is more and more focus on being able to justify the economic nature of the transaction and the arm's length natures of the transaction to make sure that the profits are taxed where the value is created. Another important highlight of this year is securitization vehicles. Securitization vehicles, they were excluded from the rules of ATOZ. So ATOZ rules, it's a limitation of interest deduction. So companies, if you look at the chart, we have here a Luxembourg company. Its investors have granted a loan to the Luxembourg company, and so the Luxembourg company is paying interest to the investors, and it deducts this interest. Of course, it needs this deduction to offset untaxable income, so it's very important that the interest is deductible. There are a lot of rules relating to interest deduction, and one of these rules is the ATOZ rules. The ATOZ rules, they will limit the interest deduction if the company incur exceeding borrowing costs. So basically, if the company has more borrowing cost than interest income of equivalent, then the deduction will be limited. So less deduction, more taxable income. Situation that company doesn't want to get in. So in these rules, the 2017 securitization vehicle were excluded. So they are not subject to this rule, and they could continue to deduct interest, even though there are a situation of exceeding borrowing cost. Only the 2017 securitization vehicles are excluded. So in Luxembourg, there are two types of securitization vehicle. Basically, there are the 2004 securitization vehicles. This is a status that the company has to adopt. The company has to indicate in its articles of association that it is a 2004 securitization vehicle. So these are in the scope of the rules. Only the 2017 were excluded. So the 2017 is not a status. It's if the company meets certain criteria, it qualifies as a 2017 securitization vehicles and is subject to certain reporting and financial obligations, but is excluded from the scope of the ATOZ rules. So that was actually practical, because these companies, they sometimes invest in portfolio of distressed loans. So they expect as an income to have not only interest, but also gains. And gains are the income that usually makes the company incur exceeding borrowing costs, because the position in Luxembourg is not yet clear, but it will probably not be considered as interest income. So basically, if there are assets acquired below fair market value, distressed assets, and there are gain expected on these assets, that is usually like a red flag for the application of ATOZ rules. So no, these 2017 securitization vehicles, they are excluded from the scope of the ATOZ rules. Then the EU Commission told Luxembourg, but this is an incorrect transposition of ATOZ directive. So the Commission sent in 2020, so yes, 3 years ago, more than 3 years ago, a formal notice to Luxembourg asking Luxembourg to change its legislation. Luxembourg has then, 2 years after, introduced a bill law to include this 2017 securitization vehicle in the scope of the rules. Today, the bill law has not yet been adopted. It's been more than a year. I think they are on purpose delaying this application. So all the 2017 vehicles are still fine today. But recently, in July, the EU Commission has taken action again and has referred Luxembourg to the European Court of Justice for failing to transpose ATOZ. This procedure that will still take a few months. There's a status quo. We are not sure whether this bill law will now be approved or not. Will this referral of the Luxembourg before the European Court of Justice speed the process? This is all open questions. What's important to remind, if you are a manager of or director of a 2017 securitization vehicle, make sure that there are fallbacks foreseen, because if the bill law passes, then there will be a refusal of interest deduction and a tax base in Luxembourg. We had already advised in the past, because this challenge is lasting for 3 years now. So most of the structure that we set up with 2017 securitization vehicle, there are already fallbacks that are implemented in the structure. For others, we would recommend to do that as soon as possible, just to make sure that the vehicle is not issuing other instruments right after the bill law has been approved, and to avoid the challenge as an abuse of law. Well, the Luxembourg tax authorities could say, we probably don't think they would do it, but you never know. But then the Luxembourg tax authorities could say, well, you issue these instruments just to make sure that you have an interest deduction and for no other economical reasons. So if this is the case, make sure it's done as soon as possible. So this year we had a lot of changes. So we have also a bill law introducing what we call the Pillar 2 rules. So these rules are derived from a EU directive, which want to assure a global minimum level of taxation for M&A groups in the European Union. So basically, where there is an M&A group, this rule will make sure that this M&A group is paying an effective tax rate of at least 15%. So there will be an additional amount of tax, which is called a top-up tax, that will be added to the low tax entities. So these rules will apply to constituent entities, so basically entities that are part of a group or a permanent establishment that is part of a group. It must be a multinational enterprise group or a large-scale domestic group. So pay attention, Luxembourg groups are also in the scope of these rules. And the consolidated annual revenue must exceed 1,750 million in at least 2 of the last 4 consecutive fiscal years. So this means that there will be a look-back exercise. So if Pillar 2 is adopted, it's below, so not yet adopted, they will have retrospective implication, because the appreciation of the result is made on the last 4 fiscal years. There are also, if you have a company that's part of a group where there have been a reorganization like mergers and division, there are also specific rules that applies for the determination of this threshold. So just make sure that you keep that in mind. How does it work? So the below is like more than 100 pages, so it's really a summary here. There are 3 rules. The first rule that applies is domestic top-up tax. So in the group, if they are low-taxed Luxembourg tax resident, they will have to pay a domestic top-up tax or tax in Luxembourg to reach this 15% threshold. The second rule that applies is what's called an income inclusion rule. So it's a top-up tax that will be paid by the parent entity. So basically, and very made simple, as the parent entity will have a look at the entities of the group, which entities are taxed at a lower rate than is 15%, and will pay an additional top-up tax to compensate for these entities. And then the third rule that applies as a backstop to the income inclusion rule is the under-tax payment rule. So this is a top-up tax that will be paid not by the parent entity, but by the entities that are part of the group. So this will apply mostly when the parent of the group is excluded from the scope of the Pillar 2 rules or is located outside the EU. So it will be very difficult to escape this minimum taxation. Impact for investment funds. I really wanted to highlight these points because what we often hear is that investment funds are excluded from Pillar 2, so there is no issue with Pillar 2. It's partially true, but it's not that simple, unfortunately. When the investment fund is a parent entity, the investment fund itself is excluded from the Pillar 2 rules. But the definition of investment fund is quite restrictive, so not all the investment funds in Luxembourg will be covered by this definition. Then the subsidiaries, direct or indirect subsidiaries of the investment funds, which are exempt, can also be excluded from the rules. But again, they are not automatically excluded. There are some additional and restrictive conditions for the subsidiary to be excluded. And even though they are excluded, investment funds are still subject to compliance requirements. So they can be excluded from the scope of the Pillar 2 rules because they don't have to pay these additional taxes, but still subject to compliance requirements. So I think another important consideration is that real estate investment vehicles are also excluded from the Pillar 2 rules. But again, it's a restrictive definition. And there are also a lot of specific rules regarding eligible profits or losses, eligible taxes, eligible assets, taxes in case of entry and exit. So it's not correct to say that just because you're paying an effective rate of, I don't know, 20% of taxes, that doesn't mean that the level of taxation is sufficient for the Pillar 2 rules, because in the different EU countries there are different ways to compute the tax base. So this rule also aims to kind of have a uniform determination of tax base for all countries. So maybe some items that will be excluded that are making this 20% tax rate, for my example, they can potentially be excluded. So compliance requirements. So that's very important because these bilateral rules will add additional compliance requirements that are not in the scope of the annual income tax returns that are filed. Like ATOZ 1, ATOZ 2, additional compliance requirements that are included in the annual tax returns. Here, there will be separate tax return. There will be specific Pilot 2 tax returns. So in this compliance requirement, there is first registration. So any company that is this, the parent entity will mainly need to register. The companies will also have to send informative top-up tax declaration. So the entities of the group will send, in addition to their annual tax return, an informative tax return on the top-up tax that they have to pay. There will be also top-up tax returns to be filed for Luxembourg tax resident parent entities. And the fines are quite high because it's up to 250,000 euros in case of non-respect of compliance requirements. So it's quite heavy fines. On the timing is this rule applies for tax year that is starting as from 31 December 2023. So most of the companies 1st January 2024. But there will be a look back exercise for the first last years and also some transitory rules that will apply a year later. So basically, in a nutshell, you have to remind that this will apply as from next year, 2024. It's still a bit low, but there are good chances that it is voted before year-end and that it will effectively start next year. And then, if you are not lost yet, we are still in EU legislation, and we have ATOZ 3. I mean, ATOZ 3 is kind of a very much discussed topic because it will oblige company to bring a lot of substance, or at least much more substance. So ATOZ 3 is mostly known as unshell proposal. It's still a proposal, so the directive has not yet been approved. It's still at the proposal level. So why ATOZ 3? The aim of ATOZ 3 is to avoid shielding assets and directing financial flows to a jurisdiction that have no tax or very low tax, or a jurisdiction where tax is easily circumvented. So the idea is to keep all these funds flows and assets in jurisdiction where they are subject to tax. So ATOZ 3 is a very ambitious proposal, in my view. It wants to fight against the misuse of shell entities, and it will tackle legal entities that don't have any minimum substance and economic activities in Luxembourg because they are deemed to be used only for tax avoidance and tax evasion purposes. So it's very ambitious. If a company is considered as a shell, there will be two consequences. It will lose certain tax advantages like double tax treaty, the parent subsidiary directive, so the exemption of dividends, liquidation proceeds, and capital gains on participations, and can also lose the benefits of the interest and royalty directive. But for Luxembourg, that means that it can lose the benefit of the exemption of withholding tax on royalties. And it will also be disregarded. So the situation will be as if this Luxembourg company that has no substance was not part of the structure. But this Luxembourg company can sometimes be used as kind of a blocker between two countries, just to avoid like withholding tax on certain payments. So if this company is deemed not to exist, there could be withholding tax on payments. There could also be tax elements that apart from the tax base in Luxembourg that will be part of the tax base in another country, subject to tax or subject to more taxes. So disregarding an entity in the structure can really have tax consequences and a material amount of taxes to be paid. Now, I won't go into all details of ATOZ 3, but basically this rule are applied through 7 steps. Only look at the first 2 because this are where you will have more practical guidance on what to do with substance. So the first step is we are looking at the cumulative risk indicators. So there are 3 risk indicators, and depending on the outcome of this first step, the company will be considered as potentially lacking of substance and needing to do additional reporting. So these 3 risk indicators, it's the income. So they will look what's the type of income of the company. Do they have what they call relevant income? Income generated from financial assets, royalties, interest, dividends, real estate, financial leasing. This type of income is considered as relevant income, and it's like a red flag. So potentially this company will need to report on its substance, because that's a kind of company that would usually be used as a shelf company. The second indicator is the balance sheet. Are more than 60% of the assets of the company located in another country? So cross-border transaction. So why have a Luxembourg company if all these assets are located in other countries? That's like an indication that this could be a shelf company only used for tax purposes. The third indicator is the outsourcing of day-to-day operation. So why have a Luxembourg company and then outsource all the day-to-day operation? That's something that's also a red flag for companies that are used only for tax purposes. Here, I also already want to flag, because I think it's important for directors, that ancillary services such as bookkeeping services can be outsourced. But that would not suffice for an undertaking to meet this condition. So only delegating bookkeeping would not be sufficient to consider the outsourcing. The outsourcing must be on the core activities of the company. And they're all appreciated during the last 2 tax years. So if these 3 relevant is, well, if one of these, if these 3 risk indicators are fulfilled, then the company will need to report on its substance indicators. And these substance indicators, they are basically the premises. Does the company have its own premises in the member state of location? So does this Luxembourg company have premises in Luxembourg, and are these allocated for its exclusive use? So then this is the question of companies that have only the address but not like a dedicated space. Second indicator is, does this company have a bank account in Luxembourg? Most of the cases we have a Luxembourg bank account, because if you incorporate a company with a contribution in cash, it's difficult to find a notary that will accept if there is no Luxembourg bank account. So I think this indicator will probably be less important, even though with the banks nowadays closing the bank accounts, it could still be an issue. So the third indicator is the directors. Does this company have Luxembourg directors or Luxembourg employees? So this means that the directors must be resident in Luxembourg or at a compatible distance. They must be qualified and authorized to take decision. They must be actively and independently use this authorization. And they cannot be employed by a third-party company. That's the first indicator. Or they will have a look at the employees, and they will have a look and make sure that the majority of the full-time employees are resident in Luxembourg and or in the compatible distance and are qualified to carry on their activity. So it's really the premises, the bank account, and the directors. So this is important to have in mind, that there will be really an additional layer of substance. Then there are other steps. I won't go into the details, but basically, based on these 3 indicators, the company will be deemed to have substance or not. If it is not deemed to have substance, there are a series of mechanisms that will allow the company to justify that it has substance. Then there are some exemptions. Okay, but it's really these 3 substance indicators that are important. Now, what's the timing? The initial timing was the directive must be implemented by 3rd June 2023 and enter into force on the 1st January 2024. So as you see, we are way behind timing. It will never work. So it's a big delay in this implementation. And why is this big delay? It's because the member states, they are not reaching an agreement on what are the substance indicators, basically. There are other disagreements, but that's an important disagreement. So there was a working group in October 2023 and update on the status of ATOZ 3. And it's very ambitious proposal. And it's basically what during this working group, there was a crucial focus on the ultimate indicators to determine if there is reporting or non-reporting. And during this working group, most of the member states did agree that there's need to change this proposal. So they were too ambitious at start. So what they want to do now is a two-step approach. They would first, there would be no ATOZ directive as such. They would first introduce all this obligation in a DAC directive, so directive on exchange of information. So the first step would be an exchange of information on substance, nothing else. No penalties, no fines, and no denial of tax benefits. So that would only come in a second step. So that's if that's the case, there will be a huge delay in ATOZ, and that would not be ATOZ would basically not be an issue for the next years. There's a big deadlock on the criteria for defining substance, and also they cannot agree on what would be the consequence of the lack of substance. Would that be a mandatory sanction, or would that be a minimum sanction? Meaning, would Luxembourg, if Luxembourg takes the minimum sanction, would another country such as France or Italy or Spain put sanctions that are of higher level? So because of all this discussion, it's now not on hold because they are still working on it, but we will probably have a directive on exchange of information. And the first step would be an exchange of information on substance. I want to remind here something, is that just because ATOZ is delayed doesn't mean that you don't have to keep that substance in Luxembourg. It's still important to have substance for tax reasons, not for Luxembourg tax reasons, but for the other countries. If you have a Luxembourg company that is investing in other countries, these other countries will have a look at the substance in Luxembourg. And if it's not sufficient, they can disregard Luxembourg. So it's still important to have substance in Luxembourg. Take the main decision in Luxembourg and make sure this is documented in the board minutes. So AU, they never stop in this context. So we have a lot of other directives and legislation in the pipe. I've just taken the most important one, or the one that will affect at least tax obligations. There's a pillar 1. It's a directive proposal. It's basically a new system of allocation taxing right between for the large groups, so M&A groups, to jurisdiction where the profits are earned and where value is created. Then we have BFIT. BFIT wants to create a current approach to corporate taxation of the EU. So basically, they will create a common set of rules to determine the tax base and the effective allocation of profits between members. So that will be more rules to determine the tax base of a company. This is, I think, the directive proposal that is on the most advanced. So probably we will see a directive quite soon. And this comes together with a whole package for transfer pricing, additional transfer pricing rules. So it's not additional rules, but it's additional compliance and request for documentation in the field of transfer pricing and arm's length nature of operations. Then we have the DAC 8. The DAC 8 is exchange of information on crypto assets and e-money. So there will be also, I think, automatic exchange of information, but there will also be. It's not in the name of the directive, but there is also a set of rules on information that need to be exchanged for cross-border ruling concerning high net worth individuals. So this is also important to know. And then last topic I think is important is FASTER. FASTER is an acronym for Faster and Safer Tax Excess Refund for Withholding Taxes. So it will basically a common EU system for withholding tax on dividend and interest payments. So it's not additional rules again, but it's additional compliance. It aims at establishing a fully fledged common new EU system of relief at source. Because for now, like if I take the example of the parent subsidiary directive, Luxembourg company distributes a dividend, it can be exempt from withholding tax under the local law that have transposed this directive. but only if certain conditions are met, notably if there is a 12-month holding period that has been met. And Luxembourg will allow to say, well, it's less than 12 months, but if you commit to hold this for 12 months, you can already benefit from this exemption from withholding tax. So Luxembourg does that, other country doesn't do that. So the idea is to create a common system of reporting on this withholding tax on interest and payment and dividends and interest payments. Then maybe a last word, which I think is not really, it's more personally for your remuneration as director. There's a big question and debate, are director fees subject to VAT? So the Luxembourg VAT authorities, they consider that the activities carried out by the director is an economic activity, so they are subject to VAT. There's one, I think it's a Luxembourg lawyer, has been in front of the European Court of Justice saying that he doesn't agree with that. That no, the activities carried out by the director are not an economic activity, they should not be subject to VAT. I think he represents a majority opinion here in Luxembourg. And so he went against the Luxembourg VAT authorities, and the courts in Luxembourg have now requested a preliminary ruling to the European Court of Justice. Basically, this preliminary ruling means that the Luxembourg is asking the advice, or the opinion at least, of European Union on what how the European rule should be interpreted. The court has not rendered its advice yet, but the Advocate General has released this opinion. It's very important, because the court will also base its decision on this opinion. And his opinion is that basically it's that to have an economic activity, there should be a personal economical risk and acting on his own initiative. And he is of the opinion that a natural person acts as a member and receives this remuneration as a member, and that cannot be considered as an independent economic activity. So basically, if the court follows this opinion and tells Luxembourg that yes, it's not an independent economic activity, then director fees would not be subject to VAT anymore. Then there are a lot of practical questions which I cannot answer, as how will this be applied, because there will be a retroactive effect. But I think Ayla is following that. I've seen that they are very engaged in that, and they already came with practical solutions. But just this is something to follow. So I hope you are still with me. Tax can sometimes be seen as a little annoying subject. Hope this was comprehensive for you, and just let us know if you have questions. You can ask them orally or through the chat, and Richard will gather the questions.
Yeah, thank you very much, Audrey. I think that was super helpful, this presentation, both for corporate and governance secretary and directors, because I think the most important is that you need to keep up to date with everything that's coming on the new legislation at EU level and Lux level, and you need to make sure you have proper reporting in place, tracking of the obligations of the entity, make sure you make the tax returns on time filed, and you pay the taxes on time, just to avoid raising any issue for the company and the liability of the directors. As we have seen, there is more and more legislation, and yeah, that's going to continue for a while, I think. So we need to be careful of that. And there is also opportunity for independent directors to get new mandates, more mandates, because of the substance that is more and more important in Luxembourg. So even though more legislation is annoying, sometimes it could be an opportunity for directors. So no, the questions I see on the chat. I was wondering if the slides will be circulated. Yes, the slides will be circulated to the full group by Ayla after that. We have a question from Katya on the VAT. So as far as I understand, the VAT rate director's fee will change as from January 1st, 2024. Has anything been published in this respect?
Yeah, we'll be back to the 70% rate because for now they haven't foreseen anything reduced rate for 2024. So probably back to 17%.
Do we have like other questions from members?
Hi, if it's, can you hear me? I don't know if it's
Yes, very well.
great. So Audrey, thank you so much for that comprehensive summary. I think everyone was quite impressed with that. Look, well, first things first, I know what you're saying, Richard, about keeping on top of things, but I think we'll all agree when we are having addendums, amendments that come every year, it's sometimes hard to understand the old regulation before it's being changed again. So that's always going to be a challenge for us, I believe. But my questions, I've got a few questions here. In terms of ATOZ 3 and its delay, and the subject of substance, will they be looking at the qualifications of board directors and the volume of board directorships when it comes to board governance and qualifications?
Yeah, they will have a look based on the rules as they are now. So they will, at our opinion is that they will probably decrease that, but as they are now, the director must be qualified and authorized to take decision. So they must be qualified. It's very wide. So they must show that they have experience, or if they are younger, that they received a specific formation. So they have to prove that they have the qualification to take the decision and to manage a company.
So are they going to be looking at the volume of directorships that some people have? Because there is a debate now on the volume of directorships versus the quality of board directorship given to the company.
That's not yet included in the rules. They are discussing that, but that's not yet included in the rules. So for now, what they say is that the director cannot be an employee of a third-party company, and it cannot also act as director in another third-party company. So it's vague, honestly. So it's not moving in the right direction for those that have a big volume of directorships. But this is one of the points that is discussed, and our view is that they probably reduce this requirement, because for now you could only have mandates in group companies.
Yep.
But we expect that this criterion maybe will not fall, but at least will be reduced.
Thank you.
We had another. Thank you. Sorry. Thank you. We had another question on the chat regarding specific substance requirements for securitization vehicles and any recommendation we can make. So we heard quite a few discussion, and some recommend that all decision must be made in Luxembourg. So maybe first of all, we always recommend all the decision to be taken in Luxembourg. I mean, that's something that's important. I guess a tax advisor will recommend that, but specific for securitization vehicle, I've not heard anything. I don't know if you did, Audrey, but I did not heard anything.
No, there's nothing specific for substance requirement for securitization vehicle, especially as from tax purposes, they are deemed to distribute all their profit. So they are mostly look-through vehicle, like they don't have also any transfer pricing requirements and so on. So no, there are no specific substance requirement for securitization vehicles. And if I may say, it's maybe less a subject for securitization vehicles, but still we recommend to have the same level of substance as another vehicle, to be on the safe side.
So we had another question again on the chat. So considering the various liabilities for directors in challenging employment market, do you recommend to put in place director services agreement with clear allocation of responsibilities in place if the company is domiciled with third services provider? So I think this question is very specific. I mean, I don't know, Audrey, if you have like a general view on the market, what's happening, but we cannot provide like specific answer to each question.
No.
But
I think general answer to this question would be that does not impact the tax liability of the directors. Maybe in certain cases it can lighten the liability, but it will not discharge the director from his tax liability. On another hand, I think from a practical perspective, it's always good to have the responsibilities and clearly allocated, because this will probably help. Avoid cases where the tax returns have not been filed. We thought it was you, no, it was you. So yes, make a clear allocation. I think it's from a governance perspective, it's a very good idea.
I have another question, please. I like the two questions that are being asked actually at the moment. If you are jointly and severally liable, but if you have been very proactive in not agreeing to the majority decisions, and that's been minuted, and then you're making decisions in the best corporate interest, but let's say that you as a board were held liable for a decision that was made, but you were very clear in the board discussion that I was not in agreement to that. To what extent have I mitigated my joint and several liability?
It's difficult to say, because this is an appreciation that is made on a case-by-case basis. But I would say first, if you had the power to stop the decision, that's what they would have looked at, if you stop the decision or not.
But usually you
If
don't
just
know, Audrey,
yeah,
if it's
I
a
know.
majority decision.
Yeah. Then I would say, yeah, it's difficult to say. I haven't seen any case law about where a manager would have clearly expressed his disagreement. Maybe they would take that into account to appreciate that maybe it can lighten the tax liability, but it will not discharge a manager from its tax liability based on current case law.
Okay.
Also questions from the audience?
Sorry, I have a question. Can you hear me?
Yes, we can hear you. Yeah, thank you.
Fantastic. I managed to unmute myself. Very great. You have mentioned that some authority might be monitoring mandates for the managers going forward, but I couldn't catch which authority that is going to be. I mean, which authority is going to manage the monitoring for the mandates?
No, it's in the framework of the ATOZ rules, which are not yet in place and probably will not become effective. But one of the indicators that the Luxembourg tax authorities will be looking at is the Luxembourg director of the company. So if basically, and just very briefly, if there is a director with a lot of mandates, that can be an indicator that the Luxembourg company has not sufficient substance in Luxembourg. And under the ATOZ rules as they are now, that means that this company could be required to prove that it has enough substance in Luxembourg by other means.
But do we know how they're going to monitor that? Because there is no such, let's say, platform, as far as I know, where neither tax authority, CSSF would have access to, let's say, all data, and they would see, let's say, manager A has 1, 2, 3 appointments, and then manager B has other appointments. And how is it going to be done? Or is it only going to be done by managers declaring themselves the mandates, the list of mandates, as they are currently doing?
I agree that for now they don't have like a database where they can check which manager is manager or director in several companies. So for now it will be based on the declaration of the managers. But I think that's a very practical question. And since it's only a proposal directive, I don't think they have gone into that kind of details yet. That will probably be a declaration of the manager or director of the company, if they keep this criteria. Because as I said, it's very ambitious and the member states are still discussing this.
Yeah, I
Thank you very
mean,
much.
we could end up in a kind of same situation as when the CSSF is reviewing whether or not they accept a mandate for a new manager of regulating the AFM, for example. They check all the mandates, so maybe, we don't know, we'll maybe end up with a full list of mandates and so on. Surprise. Do we have a final question before we close the session?
Well, I guess maybe one question before we wrap up. I don't know, but we're all very aware of diversity and ESG elements. To what extent will the new directives implement that the boards need to be diverse? You know, because obviously there's discussion about having a certain age group, certain ethnicity backgrounds, but you know, as we are moving into the diversity sort of arena, to what extent will the directives actually enforce the fact that you are obliged to have a diverse board? Do you think there will be some room on that?
That's a very good question. And honestly, it's not a tax topic, so I have unfortunately not enough time to follow all the topics. Even I think this one is a very interesting one. But they could come to such rules. I don't know. Maybe they will start. I think my opinion, personal opinion, is that they would probably start with major companies, not with companies with little substance in Luxembourg. They would probably start with major groups like M&A groups, if they do something like that.
Thank you.
Thank you, Audrey. You did not even use the Joker card for the last question, so thank you very much again for the presentation. That was great. Thank you for the audience, and see you all next year for our next breakfast. Wish you all a nice day.